Piper Sandler lowered to 7.
That the market is PayPal as deeply undervalued.
Stated that execution was not aligning with their goal.
I think the K-shaped economy narrative for the long term. It assumes zero real business growth.
Whether the new leadership can reverse the narrative and
Is this stock overvalued or undervalued? Could this stock gain 100% until the end of the year? Stay until the end of the video and to know the answer.
As of early March 2026, PayPal stock is trading at roughly $47 a share. That is down from $52 following a pretty severe plunge of 17 to 20% back on February 3rd. If we slowly break down the outstanding shares sitting at exactly 0.968 billion, we arrive at a resulting market capitalization of approximately $45.5 billion. The central question we must explore today, emerging directly from the latest financial filings and market data, is whether PayPal's currently compressed valuation represents a massive market mispricing with the potential for the share price to double, or if it's a classic value trap weighed down by fundamental execution failures and shrinking growth. I will be taking the position that traditional multiples and discounted cash flow models expose PayPal as deeply undervalued, presenting a rare upside scenario if management simply stabilizes the ship.
Right, and I take the contrasting position. The sudden leadership changes, the looming legal risks, and the flat to negative earnings guidance entirely justify the market's severe markdown. The consensus estimates are correct to be highly cautious here, and frankly, treating this as a simple math equation ignores the reality of a shrinking business.
Let us start with that math, though, because we really cannot ignore the fundamental valuation metrics. For fiscal year 2025, PayPal reported net revenues of $33.2 billion. That is up 4% year over year. The GAAP earnings per share came in at $5.41. When we apply that EPS to the current market price, we are looking at a price-to-earnings ratio of just 8.7 times.
But a trailing PE...
Striking. If we factor in their $3.2 billion in net debt, we find an enterprise value sitting around $42.3 billion. Divide that by their estimated EBITDA of $7.06 billion, and we arrive at an EV to EBITDA multiple of roughly 6.0 times. These are, historically, incredibly low multiples for any technology or finance firm. The market is pricing PayPal as if it were a dying brick-and-mortar retailer, completely ignoring the bright spots. Venmo's fourth quarter revenue grew by an impressive 20% to $1.7 billion. And the PYUSD stablecoin market cap surged from $500 million to $4 billion in 2025. These are robust, cash-generating assets being irrationally discounted by a market that is just overly focused on short-term noise.
Well, the problem with leaning on trailing multiples, no matter how historically low they appear, is that they do not dictate future returns. A P of 8.7 sounds like a bargain until the E, the earnings, starts to structurally degrade. We have to focus on the forward-looking guidance. Management itself is projecting that 2026 non-GAAP EPS will be, in their own explicit words, flat to down mid-single digits. That is the underlying reality we have to price in.
But guiding down mid-single digits for one transitional year does not warrant a sub-9 PE ratio for a company generating over $5 billion in pure profit.
Fourth quarter miss. Revenues of $8.68 billion and non-GAAP EPS of $1.23 both fell significantly short of expectations. And the explanation management gave was highly concerning. They cited slowing online checkout growth in a K-shaped economy. What does that actually mean? It means the lower to middle income consumers, which make up a massive portion of PayPal's legacy user base, are actively pulling back on discretionary spending. Meanwhile, the higher income brackets are increasingly defaulting to Apple Pay for frictionless checkout.
I think the K-shaped economy narrative is a macroeconomic headwind, certainly, but it is not unique to PayPal. Every digital payments processor with exposure to discretionary e-commerce is feeling that exact same pinch.
Yeah, but not every payments processor just fired their chief executive over it. That is the most severe red flag in this entire narrative, the sudden CEO shuffle. Alex Chriss was supposed to be the visionary product leader. Instead, he was abruptly replaced by HP's Enrique Lors. Effective this month, March 2026, the board explicitly stated that execution was not aligning with their goals. Swapping a fintech product guy for a legacy hardware operational executive is a massive shift in corporate DNA. It signals panic. A low PE ratio is entirely justified when your core branded checkout is bleeding market share and your board is making emergency leadership changes.
Let's look at how we reconcile these forward projections with actual cash flow generation, because I believe the panic you are describing is severely overstated. Let's slowly walk through a simplified discounted cash flow, or DCF valuation. We do not need a miraculous growth story to see the upside. We just need to look at the cash. If we take a free cash flow base of $6.0 billion, which aligns strictly with the company's own conservative guidance for 2026 and 2027, and we apply a standard 9% weighted average cost of capital,
which assumes the risk profile remains stable, I might add,
alongside a highly modest 2% terminal growth rate. For clarity, a 2% terminal growth rate essentially assumes PayPal just paces with standard inflation over the long term. It assumes zero real business growth. Even with those incredibly pessimistic assumptions, the enterprise value sits comfortably around $90 to $100 billion. That implies a fair value share price of approximately $93.60. That is virtually double the current trading price. The math is undeniable. And analyst firms like Keefe Bruyette, KPW agree. They currently maintain an outperform rating with a $90 price target, proving that if you look past the immediate quarter, the intrinsic value is massive.
The intrinsic value is only massive if the inputs are grounded in reality. The assumptions in that DCF model are far too optimistic given the current operational realities. Let us look at the TKR consensus model instead. That model projects only 4.2% annual revenue growth and, crucially, mid-teens operating margins. PayPal is having to sacrifice margin to maintain transaction volume, essentially buying revenue through lower take-rate products like Braintree. If you run the TKR numbers, it suggests a stock price around $49 in 3 years, implying an exit PE multiple of just 6.7 times.
An exit multiple of 6.7 times for a company with a dominant global merchant network is practically apocalyptic. It assumes the business is actively dissolving.
We are assuming the business is mature, highly competitive, and losing its moat. We have to acknowledge that the average 12-month analyst target is currently sitting at roughly $50.50. Doubling the share price to the $90 range requires a 10 to 15% bull scenario. That is a scenario requiring perfect operational execution, massive macroeconomic tailwinds, suddenly returning the middle-class consumer to 2021 spending levels, and surging highly profitable stablecoin adoption. Right now, that scenario lacks any real catalyst.
We are entirely ignoring a massive shift in capital allocation that provides the exact catalyst you claim is missing. It provides a significant, tangible floor for this stock. Management recently announced a new 14-cent quarterly dividend, their first ever. But more importantly, they announced a $6 billion buyback and dividend program.
Paying a dividend is often an admission that a growth company is no longer a growth company.
Oris, it is an admission that the market is mispricing the stock so severely that returning capital is the highest ROI decision management can make. When a company is trading at 8.7 times earnings and generating $6 billion in free cash flow, aggressively repurchasing shares mechanically boosts earnings per share. You are retiring a massive chunk of the outstanding flow at bargain basement prices. The downside risk becomes heavily mitigated by that daily buying pressure from the company itself. Additionally, I view the leadership change not as a red flag, but as a necessary operational catalyst. Enrique Lors taking over as CEO could be exactly what is needed. He has a track record of ruthless efficiency. If he accelerates the rollout of their new initiatives, integrating artificial intelligence into consumer targeting, deploying biometric checkout features to compete with Apple, and further integrating the PYUSD stablecoin into corporate treasury operations.
Let's pause on the new initiatives for a moment, because the institutional community clearly does not share your optimism regarding Enrique Lors. Following the CEO change and the earnings miss, we saw severe analyst downgrades across the entire board. Rothschild and Redburn cut their 12-month target from $50 all the way down to $32, issuing a firm sell rating. Citigroup lowered their target to $42, Piper Sandler lowered to $74 but maintained a neutral rating. Wall Street is looking at an HP executive taking over a complex digital payments ecosystem, and they're deeply skeptical.
Analyst downgrades often trail the price action. They're reacting to the 20% drop on February 3rd, not predicting the next 12 months.
Investigations by the loss of transparency. And that brings us to the critical legal risks currently weighing heavily on the stock, which your DCF model completely ignores. On February 25, 2026, the law firm Levy & Korsinski announced an investigation into PayPal's fourth-quarter disclosures. They are specifically questioning whether management actively delayed releasing negative metrics while emphasizing adjusted non-GAAP figures to prop up the stock before the leadership transition.
Investigations by class action law firms follow virtually every 20% drop in a major equity. It is a highly predictable pattern.
But it escalated far beyond a simple investigation. On March 6th, Kessler, Topaz, and affiliates filed a formal securities fraud class action lawsuit on behalf of stockholders who purchased shares between February 2025 and February 2026. The complaint explicitly alleges that management created a false impression of growth and actively misled investors regarding fundamental execution risks in the core checkout business.
The burden of proof for securities fraud is incredibly high. In alleging a false impression of growth when the company transparently reported a fourth-quarter miss is contradictory.
The core issue is trust. We know that the February 3rd earnings miss and the sudden CEO change drove the stock down 20.3% in a single day. When you have active legal allegations of delayed metrics and obscured realities, it destroys the trust premium. Institutions will not pay a higher multiple for earnings they suspect of being engineered or obfuscated. And without trust, any multiple expansion, which your valuation desperately relies on, becomes impossible in the near term.
While I concede the legal noise is loud and the optics of a CEO swap alongside a class action filing are poor, the downside is already entirely priced into a $47 stock. Let us objectively look at the base case versus the bear case. I assign roughly a 60% probability to the base scenario, which targets a price recovery to the $50 to $60 range.
Based on what operational improvement?
Based on the fact that even in a highly modest scenario where core branded checkout growth is entirely flat and Venmo merely maintains its steady double-digit growth, rather than accelerating, the investor still realizes a 10 to 30% upside from current levels. As execution steadies under new leadership, those $6 billion in buybacks systematically reduce the share count. To justify the bear scenario targets of $30 to $40, which the Rothschild downgrade suggests, you have to assume a massive systemic failure of the entire PayPal ecosystem.
I do not think a systemic failure is required to hit $30.
You have to essentially ignore the fact that PayPal generated $5.23 billion in net income in fiscal year 2025. A business generating over $5 billion in pure bottom-line profit, with $33.2 billion in top-line revenue, simply does not trade down to a $30 valuation without an existential collapse. We are talking about hundreds of millions of active accounts. You are pricing in a scenario where those accounts disappear overnight.
I assign a very realistic 25 to 30% probability to that bear scenario. And again, it does not require an existential collapse. It only requires the current trends to persist. It is incredibly realistic if consumer spending continues to shift away from discretionary e-commerce and if fintech competition, specifically Apple Pay and Stripe, continues to steadily erode their branded checkout dominance.
Apple Pay and Stripe have coexisted with PayPal for years. PayPal's total payment volume continues to grow despite them.
But the margins on that volume are shrinking. We cannot ignore that while PayPal is heavily investing in new initiatives like Buy Now, Pay Later, BNPL, and their PYUSD stablecoin, these are medium-term projects at best. Analysts routinely caution that these initiatives have not materially boosted bottom-line earnings yet. They are expensive to scale and highly competitive. If the core branded checkout declines further because it is a multi-step process losing out to one-click biometric alternatives, and the new initiatives fail to bridge the revenue gap, then missing estimates again becomes highly probable. If they guide sharply lower in the next quarter, $30 to $40 is not an extreme assumption. It is the mathematical reality of a shrinking enterprise.
As we draw our discussion to a close, I will summarize my position on this divergence. On a purely mathematical basis, trading at an 8.7 PE ratio, with a 6.0 EV to EBITDA multiple, alongside massive free cash flow generation of $6 billion annually, PayPal presents an undeniable margin of safety. The introduction of the dividend and the aggressive share repurchases provide a firm floor, making this an asymmetric bet. The market is pricing in structural ruin, but the balance sheet shows a cash fortress. If the e-commerce sector slightly rebounds, or if Enrique Lores simply stabilizes the internal execution and cleans up the reporting transparency, the upside potential to the $90 range is vast, and the downside risk is already fully realized in the current $47 price.
And to summarize my perspective, cheap valuations mean absolutely nothing if the core business is bleeding. We are looking at a classic value trap. The combination of flat-to-down EPS guidance, sudden leadership instability with a CEO ousted specifically for poor execution, and active class action lawsuits concerning transparency demands a substantial risk premium. A low multiple is not always a bargain. Sometimes it is a perfectly accurate reflection of structural decay and eroding market share in a highly competitive digital landscape.
We both clearly acknowledge the profound tension here between PayPal's undeniable trailing financial strength and the very real forward-looking operational decay.
Precisely. The true value of this company over the next 12 to 18 months will depend entirely on whether the new leadership can reverse the narrative and regain institutional trust before the core checkout business degrades any further.
We invite our listeners to look closely at the fourth quarter 2025 earnings materials and the recent SEC filings. Evaluate the transparency, the growth metrics, and the legal disclosures for yourselves. There is certainly much more to explore in the material.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!